Hello and welcome, everybody. My name is Sarah Snell Cooke. I'm your co-host, co-founder of the Credit Union Connection, and I am here today with Joe Brancucci, who probably doesn't need much introduction, but he's currently the Executive Vice President of CU Results at CU Strategic Planning. Welcome, Joe.
Good morning. Good to
Uh,
meet you. Good to meet you. Good to see you again.
yeah, we've known each other a couple decades at least. Um, but
Just
so
a
I'm
few.
going to let you go a little more into the introductions. Far as I know, you have a multi-decade history in credit unions, as we were just talking about, and also exactly what CU Results is, because it's relatively new for CU strategic planning.
Yeah. So yes, I am kind of a long-time credit union executive, many decades now, from tiny credit unions to one of the largest in the country. My specialty has always been lending, and really being on the forefront of innovation in that particular discipline, and being able to improve the member experience in various ways, and still maintaining safety and soundness, which is always going to be my, kind of my backup plan here, just to make sure that credit unions don't ever get in trouble when they do things that are new and exciting, but that doesn't mean they can't do those new and exciting things. I have not been very successful at retiring. I've tried it 4 times so far, but so I work now with CU Results. And CU Results um, a division of CU Strategic Planning, which is a division of Callahan and
Yeah.
Associates. But we specialize in actually going into credit unions and helping them reimagine their operation, from everything from the way a member comes in the door and how they're treated, to how they do loans and how they create educational curriculum for their members and their staff, and the partnerships they can create in their communities, so that they can be not just better CDFIs but better credit unions. And that's
Yeah.
really the focus that we have. And we work with credit unions that range in size from $15 million was the smallest, and $3 billion was the largest at this point. And although we have a couple of larger ones on the horizon, but again, it's kind of exciting to help them see a new way of doing business. And just leveraging their strengths, and getting rid of some of the obstacles that we all seem to have in our processes, uh,
Hmm.
that have evolved over time. And as I call it, part of it is regulatory distress, where everything is designed to make the regulators happy rather than figuring out how to make the members happy, and back into the regulations.
Yeah, yeah, that's what I love about your lending philosophy. Is it really is all about the members. Um, and so right now, of course, the Fed is making exciting news, down another 25 basis points with last week, I guess. And so how is that going to affect credit unions lending going into 2025?
I think there's a couple of things working on lending right now. What we're seeing is that, in the lower tier credits, on the lower income households, they have been pretty much not borrowing a lot, having enough trouble making ends meet. So they're not buying cars as often as they would. Houses are out of reach for almost every segment at this point, and the combine that with the high interest rates, it's been kind of interesting. Seen in the last quarter, though, a lot of activity picking up. Home equity has been a kind of the credit union product for the last 2 years. I mean, that's the one that folks, well, if I'm going to stay in the house and I'm going to do some improvements to it, since I can't really move, and I'm not going to give up my 2.5% mortgage for a 7% mortgage, and so I'm going to do whatever I can. Although home equities have a downside, because obviously they're variable rates, and the rates have significantly gone up, and some of those folks are now having payment shock, which is a new opportunity for credit unions, I think, to look at those home equity loans, and maybe even a mortgage refinance might be beneficial when you're figuring they're prime plus something, and
Mhm.
the home equity loan, and when they were nothing, or if they've come up and they're now on repayment schedule plus the interest rate, that may make them have a more household shock. So there's things like that that are going on in the industry. A lot of credit unions, though, are doing things that are not organic necessarily, because it's a little harder to get organic loans. So they're buying participations, or they're buying uh, jumbo mortgages, or they're buying loans from a fintech of some sort. And so it's a there's a changing dynamic going on, and I think that's going to be interesting to see how that plays out, because the fintechs are kicking our butt when it comes to our product, which are signature loans. And that's kind of a sad thing since that is our product, but yet we are afraid of it as an industry. And auto dealers, well, I think the captives are coming back in with some 0% financing, other deals. And so, we've got to really figure out how to operate in the white space. And so that's what we're telling our credit unions. We're working with identifying what opportunities we see based on it. We do a very detailed environmental scan of their market, and we do a competitive analysis. We actually do mystery shop of their competitors and
Mhm.
identify opportunities for them to go into those particular areas and be the lender of choice rather than a secondary choice or not a choice at all. So
Mhm.
those are the things we're seeing. But credit unions that are shifting and understanding their market shifts are successful. Those that aren't are just not lending at this point, and you can start
Yeah.
seeing that. And then, of course, you have the industry-wide issue of liquidity, and they've got a lot of low interest rate mortgages. Hopefully, if rates continue to come down, although for some reason the 10-year Treasury is going up as rates come down. I'm an economist. That's kind of a weird scenario, but that's what seems to be happening. Um, but assuming rates do start coming back down, those loans that have been stagnant in their portfolios maybe be able to push out and
Mhm.
they'll start being able to lend again.
Yeah, and recapture some of those loans they haven't been getting.
Right.
Credit, and I was reading the other day that credit unions have lost their edge in auto lending, in particular, they've fallen behind the captives, who are getting all the loans apparently. How can they get back into that?
I think there's a couple of things and I've seen this, and so it's kind of interesting. And I asked that question of a credit, not of enormous size, but they're about $1 billion. And I said, your automobile lending is really, really slow. Well, intentionally, we're only doing A plus and A credit. And traditionally, we've lent to B, C, and D, or tier two, three, four,
Hmm.
and five. And I said, why do you do that? Well, because the economy may change and things may go bad. So you're not lending to your members, basically, because you're worried about them having problems. Isn't that what we're there for? So to manage that. And if you're pricing the risk appropriately, you should be doing okay. But there's been that problem that they have made it difficult. If the captives haven't made it difficult, you still can go in and get a loan in any
Hmm.
of those tiers. So, if I had a credit union that told me the other day, well, we have the best rates possible in our lower tier credit. We're the lowest rates in town on those credits, the tier three, four, fives or CDs, depending on how people rate it. And I said, so let me look at your loan process and guidelines. And so they made it kind of an American Ninja Warrior obstacle course to get a loan in those tiers, which nobody could possibly ever succeed at. So of course, we're not doing any buy-in.
Right,
So
right.
price appropriately for the risk and loosen up some of these obstacles you put in place to make the folks not be able to lend. And I think that's
Hmm.
my entire career, every place I've gone, I found that to be the issue is that we put in obstacles that we think translate to safety and soundness. And all it does is reduce the actual return on the portfolio because all we're doing are A plus and A, which are basically rate. That's a competitive rate. If you don't have a competitive rate, you're not going to get an A plus an A. The other
Hmm.
tiers, if you do that correctly, you're going to make a lot more income for your memberships. You're going to have a better value for the member getting those loans, and the credit union will do better. But it's a hard discussion to have because a lot of boards like no delinquency, no charge offs, but we want to lend to all of our members. Okay, but your members are all C, D, and E credit to begin with, so
Right.
you're going to have charge offs and delinquency. You just need to understand how that works in the
Yeah.
realm of pricing, and that's the problem. They don't understand risk based pricing.
Hmm. Okay. For lenders, that seems interesting to say.
Yeah, it is interesting.
um, so, um, uh, there was, I actually, hot off the press, Equifax was just saying there's been a slight uptick in subprime lending, which I thought was interesting. It's probably not the credit unions, or at least not a lot, some of the credit unions anyway. Why do you see that happening?
Mm. I didn't read that particular article, but you know, first of all, I don't know what they're defining as subprime.
Hmm.
There's subprime, which is to me, someone that's below maybe 580 or 570 or something in the credit score. But there's some that's that's not necessarily how they're defining subprime. They
Right.
may be
That's
defining
true.
it as near prime rather than subprime. And
Yes.
near prime lending is where credit unions are starting to slip up on. They're not doing
Mhm.
that near prime loans. You have A plus and A is prime. Everything else is near prime until you get down to the lower tiers, in the below 630s and
Oh, yeah, I was gonna say,
low
I've heard
580s.
630 referred to as
Well,
subprime.
630, 630 is usually my marker for, these are relatively okay loans. You can manage it either through price, through a much more aggressive collection paradigm. I always talk about when I teach lending to folks, don't do risk-based lending if you don't understand that you have to have a risk-based collection paradigm behind it. Otherwise, you're taking a pail of guppies, which are these subprime, these loans that are in the lower tiers, and you're throwing them in the ocean and you're treating them like every other loan. And then you
Mhm.
wonder why your charge-offs are higher than you projected them to be. It's because you need to be on them quicker. On a loan in those lower tiers, you need to be on the collection paradigm up front. And you
Mhm.
spend too much time worrying about a $500 loan and not enough time worrying about the bigger loans that are in those tiers. And you worry about the A plus person who's delinquent. Well, if they go delinquent, they're probably going to pay you and you'll get a higher yield because you got a late charge. What a concept. So, use your resources more effectively, but they don't really understand that part.
Mhm.
When I've gone into institutions and had to rework lending, sometimes rework the entire institution. Um, the first thing we did was build the infrastructure to be able to support risk-based lending.
Mhm.
We didn't go out with the loans first and then say, oh, well, we need this collection paradigm to change or the way we monitor it. So they don't think that through. So, but back to the real problem is they, they don't want to have loans that are going to be problems. And it's an inherent issue. I've was on the speaking trail a couple of weeks ago, and I was talking to a number of credit unions about something else, and we brought that discussion up, and they all said the same thing. Their boards don't want to see charge-offs and delinquencies go up.
It's
And
gonna. I'm on
you
the board of
know,
a credit union, they're gonna.
I mean, first of all, delinquencies went up in the last few years just because there was a lot of uh, inflated credit scores based on the fact that there was a lot of government money going into the pockets of the consumer who kept their credit card balances low and or paid them off, and then they were able to refinance their house and paid off all their debt. So they had these really inflated credit scores. And now you're seeing a more normalized credit score, but that 780 is really a 630, and that's a big difference in
Mhm.
how that loan's going to perform. And so, as I said, get over it and figure out how to work through it and start moving
Mhm.
on. But don't stop lending because of that particular issue.
Mhm.
Understand what happened. And that's the other thing. We tend to knee jerk react to things. Well, this happened. So all the loans we're underwriting are bad. Stop doing unsecured lending. Stop doing anything in the lower tier. Well, why don't you figure out why it happened? And then when you figure that out, make any adjustments and then move forward. And I think
Mhm.
credit unions are not good at doing that part of it. They never have been. And you can see it if you very cyclical lending in the credit industry. Things get a little bit rough and lending drops down to very minimal levels. Then the economy seems to be great. Things can be okay. And then they get back into it, they come out.
Mhm.
And I'm a big believer in steady as you go. You need to
Mhm.
constantly be lending, and you're adjusting what you're doing underneath the lending activity rather than adjusting your
Mhm.
volume.
Well, I think in addition to being a lending issue, that's also a marketing issue that I've seen where nobody has a strategic marketing plan. It's just campaign, campaign. Oh, what do we need now? Auto loans, da da da. And so
Yeah, I
that's
agree
a
with you.
lot of the way the marketing goes.
But I also think that credit unions make a mistake instead of marketing value, which would be the
Mhm.
experience. So they market price, and in
Mhm.
this in this particular world, the world of social media, and you know, it is an open market. I can find a loan in, I don't know, Iowa today if I wanted one that was probably better than I could get with my local credit union here. The reality of it is, what's going to make that different? Because an auto loan's an auto loan or auto loan. It's just going to be rate. That's all it's going to be. So it's got to be that experience. Credit
Mhm.
unions, the credit, in my opinion, this is an opinion, but it's kind of worked for me over the last 4 decades. Credit unions who focus on creating a unique member experience will always succeed because that's their
Mhm.
brand. That's the
Mhm.
difference. Do you listen? Do you have empathy? Is it part of a bigger plan when you talk to the member about their life? And are you going to be relevant? Chip Philson used to talk about relevancy in speeches he used to give across the country. Credit unions were real relevant in 1935, right? You're a Boeing employee worker, the machine and a machinist, the credit union financed your tools, which got you that particular job.
Mm-hmm.
Today, you're a member of Boeing Employees Credit Union, unless there's something special about the membership, about the relationship you have with that credit union. There's nothing unique about the products anymore. No,
Mm-hmm.
Boeing pays for the machinist tools now. They don't have to buy their own machinist tools. I don't use that as an example because obviously I have a lot of experience with that particular credit union, but but there's no difference. Every one of the credit unions you talk to is the same issue. How do I be relevant? Um, and the way you be relevant is to be human. I really think being human is a really interesting concept for credit unions. They're getting to be like banks, although banks are trying. I'll give B of A credit that if you walk into a B of A branch, they are much friendlier and much more open to having a discussion with you, or at least talking to you, than they used to be. We're much more transactional. They need to move back. We need to move back towards relationships to get rid of transactions and everything. Otherwise we are going to get.
Yeah.
I don't know. I'm not even sure what we're going to get over time. We're just going
I
to
feel
lose
like
that.
we're commoditizing ourselves. Yeah.
Yeah, and that's a great word for it. I think commoditizing is the right word. I mean, there's nothing unique about a lot of credit unions anymore.
Mm-hmm. And
Now,
in the
there are
case of
many
the
that
ones that are tend to be more unique are the smaller ones that are unfortunately we see getting merged away every day, which is what guys like you try to help avoid, right?
that's what we're trying to. Actually, I worked with a credit union. I won't say which credit union it was, but I worked with a credit union recently in the eastern southeastern part of the country, and their reason for working with us was they wanted to find a way to make sure that they didn't get merged. They wanted to
Okay.
figure out how they could be relevant in their communities in a way that would make them unique and be able to sustain their model.
Mm-hmm.
And we think we gave them that particular path, and that it's caused them to really sit and think about things in a different way. And they wanted to make sure that members were empowered, and they had financial empowerment, and that they could everything that they did could focus on that. And we built a model around financial empowerment and everything that means. And we
Mm-hmm.
kind of that's really what, if you go back to the relevancy, you go back to the 1930s and 40s. I mean, the relevancy was that we were giving them the tools to start a household, to be empowered
Mm-hmm.
to do that. And we were there during that period of time. We've gotten, when we stopped doing signature loans, and we're afraid of unsecured credit because it's going to break us down,
Mm.
rather than indirect loan, which is basically an investment. It's not a loan anymore. Let's get real here. Those members that go through the dealers are not loyal members who joined the credit union. They bought a shiny Mustang that happened to have a loan that they needed to finance it, that happened to have a credit union attached to it. That's a long
Mm-hmm.
distance from making a relevant decision that the credit union is going to be relevant in my life.
Mm-hmm.
And so, and that's an interesting thing. Having been a proponent, and I sat on the board of Tuttle and I did all those things. I think we kind of got away from the reason that we started to do indirect loans, was to give the members access to loan products at the dealership. And now we've got the dealerships becoming the source of membership. That's a different paradigm. It's not
Definitely.
right or wrong. It's just we have to understand what that's done to our ability
Yeah.
to
It
to
provides
be.
volume, but then volume doesn't necessarily provide the depth of the membership
No,
and the
but you also,
relation.
if you're using the same rates, if you're a member and I'm a member of the same credit union, and um, John is not a member of this credit union, and John gets an automobile loan at the same rate you and I get it, and we pay the dealer 2%, we just took 2% of the cooperative value and send it to a third party,
Mm-hmm.
which reduces the overall value of the membership.
Mm-hmm. Which
So,
probably wasn't that valuable lifetime over to continue to start with. Yeah.
right. But it used to be a very small dollar amount. It's 50 basis points or something. And the paperwork, you could equate the expense to the dollars. But
Mm-hmm.
now it doesn't work that way. But again, what
Mm-hmm.
did you get? So you got a loan. Okay. Because you have bought a package of loans from somebody, a participation package of loans at current market rate, at the current, whatever the value of that loan package is, versus
Mm-hmm.
paying a premium for a market loan.
Mm-hmm. And diversified that your loans because you got more than one.
Right. So, again, there's no right answer to this, but
Mhm.
some credit unions have adopted a fully indirect lending strategy. That's all they're going to do. 80% of their loans are indirect. So you're getting members in and you're getting a loan in, but what's your loans per member? I can remember a
Right.
time when I was at the the large credit unions. We used to have a ratio that we would shoot for, of having a new member in the first 4 years, we'd want to have 3 relationships. They had a mortgage, we wanted to have 6+ relationships. And we measured it. And that was
Mhm.
important because
Mhm.
that meant we had a relationship with the members. We didn't have
Mhm.
a single product, transaction with the member.
Mhm. The
And
efficiency is almost killing us, that we're trying to be efficient, like, for example, doing all in indirect auto lending, but there is a point where efficiency goes too far, which is I mean, I'm sure it's hard to feel out, where that line is. Um,
but I think you can be very efficient
oh, yeah.
if you have an alignment between strategy,
Mhm.
the strategic marketing plan, and the strategic lending plan. And when there's alignment there, it works wonders. I mean, I can give you many examples of credit unions I have personally been involved with and credit unions that I have worked with that have been
Mhm.
able to align those things and be very, very successful.
Mhm.
And it's not, if marketing is, if, well, actually, it goes back to everything. Everything
Mhm.
in a credit union has to be aligned. I mean, that member experience the first time they walk in has to be welcoming. The arms have to be open, and we have to be listening to the member, whether they're a 630 or a 780. We need to look at them the same. The pricing may be different, but how you treat them should be the same.
Mhm.
And are we really planning to be a financial partner for life with that member? Are we
Mhm.
really doing that? There's a credit union I work with. It's one of my favorite credit unions. And in the ideation session, the CEO said, well, I want to be the member's financial partner in the journey of life. Financial partner in the journey of life. That's a really significant statement because it really epitomizes what credit unions should be doing, right? No matter where they are in that continuum, and they join you, you should be their partner in their in their
Mhm.
their financial partner in the journey of life. There's ups and downs, there's good times, there's bad times, there's needs that. My favorite analysis is when you think about why formation households don't go to a bank or get into the habit of going to um, uh, a payday lender or check cashing company because they need their first deposit for a rent on their apartment.
Mhm.
And they go to their credit union. They say, "Well, you don't have a lot. You got out of college. You just started your job, or you just got out of high school, and you just started your job. So you don't have a long enough job history, and blah 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 blah. So you need to go elsewhere to get that first loan."
Mhm.
So we just sent away our member because we didn't understand the fact that what's special about having a long-term you know, well, they've been working for 3 years, so they got fired next week. And,
Mhm.
what did you take the time to understand where they were in that continuum? So yes, they just graduated high school. They went to a trade school and now they have a job, but dental hygienist, I'll just take as one, they went, and so they just started the job. They went to school though for it. You can see their diploma. There's another way of approving that loan rather than saying, no, we're not going to do it because you don't have more than 2 years in the job.
Mhm. Yeah.
And
Yeah.
yet there was no way they could have 2 years in the job based on how old they are or how far they come out of school. You'd take a doctorate. That would be a great one. They've gone through all the school, medical school, and everything else, and they come in and they want to they want a loan for an apartment or whatever for their deposit. I said, well, you haven't been on the job long enough. Just went through 15 years of school, like, so
Yeah.
we have to be intelligent about it. We really have to step back from our process and understand who the person is and
Mhm.
who they are, where they are in their life stage. What experiences have they had? Is there another way of approving those loans rather than looking at some checklist that says they have to be there for 2 years? Yeah.
Mhm.
So I've recommended almost every one of them come up with some alternatives to that. Now
Mhm.
I get it if somebody's 6 months in a job, within a job security. there's something wrong with the person if they can't keep a job for more than a few months. But that's a different scenario than what I just described.
Right. Mm-hmm.
But yet we manage, and I think we have found this to be always interesting. Credit unions tend to have policies and procedures based on the one incident that was really bad that happened some 25 years ago. And
That's
so we're going to continue that thing going on forever and ever. And I'm kind of an efficiency expert, so give me the value of that step. But there's no value when you get rid of the step. But the same thing with some of our policies is that we have to kind of look at why are you asking for that requirement of every applicant that comes in the door? And usually when I forensically go to the folks and ask them why, well, in 1987 we got we got taken advantage of by a member who did this, this, and this, and this, and this. So one member in the last 50 years, and you have a process now to make every member go through that hoop that produces no
mhm.
value for the transaction. And
Sounds like
that's one of the,
regulation.
yeah, well, that's true too. But that's one of the reasons. That's one of the things we do with see results. We actually kind of strip it back and ask why. Explain to
Mhm.
me. Yes, now sometimes there's a good reason for it,
Mhm.
but if they say because or we've always done it that way, my
Mhm.
favorite terms that usually shake my head and say, well, what if you stop doing? What would be the risk? Well, we could have an incident like that. Okay, but you would make if you made 10,000 new loans and you had one incident, is that a problem?
Mhm. Yeah,
And
exactly. You look at the 2%, if you focus on the 2% of members who defraud you or whatever versus the 98% that are doing their jobs, you know.
right, most folks are not going to get you. Now, obviously, if you have big holes in your processes and whatever else, and you don't do the right kind of process, you're going to get taken advantage of. But if you're doing the right things and you've got a credit model that wasn't less validated when Eisenhower was president. Um, you know, some credit unions are using models that they haven't validated in 10 or 15 years. Well, why are you using those models? Because we never thought about validating them again. Well, do you know
Mhm.
that they only have an average life of 2 or 3, maybe 5 years at the most? After that,
Mhm.
they become obsolete, and they may not be predicted. So they say to me, so what's the problem? I said, well, let's look at this. If they're not projecting losses appropriately, and you're pricing based on that model, and you're underwriting based on that model, you may be either too conservative or too liberal.
Mhm.
And that's not going to bode well because what's going to happen, remember that board that doesn't like delinquency and charge off? You're going to have unexplained delinquency and charge offs in a tier that you weren't having it before because your tier is incorrect.
Right. Yep.
So it's or I'm total supporter of Rex Johnson method and those kind of schools, but you have to look at and evolve those models that you have underneath. You can't just have it once when you did the training 25 years ago. It doesn't work anymore.
Right. Exactly.
And he would be if he was still alive, he'd be the first to tell you need to make sure your models are working.
Right.
So,
Yep.
but so to me, it's
Yep.
just you got to evolve. Lending is not a static activity; it's an evolution. It's an activity that has to evolve. It has to evolve with market conditions. The risk model has to evolve based on things that occur. I mean, that happen. Your universe may change.
Absolutely. I
So,
mean, you look at just our recent history in the last 15 years or so has been crazy financial markets.
and I remember the first time there were a few credit that did credit scoring in the 90s. I mean, Diana Baxter Golden one was probably the first one who did it. I remember going to her office. She had I don't know 6 and 7 foot high reams of green bar paper with all the credit model stuff in it, whatever. But she was one of the first that thought about it, and then with help going a few of the others. And I used to when I first got to the ECU, I used to actually go out in the road and teach credit scoring because they didn't understand credit scoring. Credit unions weren't doing credit scoring. They had their own little sheets. I can remember when I first started being a lender many decades before that, where we had in-house scoring models that we would create. You get
Hmm
5 points for having uh, an account with the power company, and so many points for something else. But
hmm
it was really kind of arbitrary. It was just homegrown. But when we started using credit scoring, credit scoring is just a traffic model, right? It's a traffic manager. It tells you where to do and what to do with the loan. So if it's an A plus, it's an 850 credit. Don't worry about it. You're not going to go bad. If you walk into a dealership and they run that credit report, which they always do, and you have an 850 credit report, they say buy anything you want to look on the You can afford anything you want. Don't worry about it. We'll figure out how to get the financing for you because they know they can.
Mhm. Yeah.
We don't do that. We go and we want to do 47 other analyses and do the other stuff. Well, what do they know that we don't know?
Mhm. Yep, for sure.
So, but we're much smarter than most lenders. We have the most sophisticated systems and understand everything.
Mhm.
Not, but and I'm going to go for my own teams. I mean, I've had I can remember at the last credit union that we would go through the lending policy and guidelines once a year and say, okay, why are we doing this
Mhm.
particular step? And we would every year we'd probably cut out 10% of the steps
Mhm.
just because they didn't make sense anymore, or we were using a new model of some sort, or we added AI, or we would go and had alternative credit models or other things that would change the way
Mhm.
we do things, or we were able to validate income, through electronic means rather than through a piece of paper. And so you get rid of a lot of steps that way.
Mhm. Yep. Yep. Great efficiencies there for sure.
Oh yeah.
So for CU strategic planning's CU results, for CU results, um, what are the biggest issues, maybe the top 3 biggest issues you're seeing, and how are you solving those with your credit unions?
The biggest issues we're seeing, and it's almost in every case, there are artificial obstacles that are put in place, whether it's a loan application fee, which to me is like so 1960, but a loan application fee, because if you have someone who's in a low income or moderate income, you're going to give you $50 and you're not giving
Mm.
it back if the loan's denied. Why would I give you that even to try to make the loan?
Yep.
We're seeing artificial deposit requirements with loans, but more importantly, we're seeing documentation requirements that do nothing for the loan.
Mm.
Asking for two references, which is again very 1960s way of underwriting loans. I can tell you that because I was around when that started. It really serves no purpose. And you ask the head of collections, well, okay, so you have this reference in here. When the loan goes bad, what do you do with the reference? Well, we call, but you can't really say anything about the loan because of the laws that have been passed since that time. When reference, you could
Mhm.
ask somebody else. Well, no, but we can see if we can track down the member. But how do you even have that conversation since you can't tell them that they have a loan with you? So, what are you really getting it for? And the answer is usually dead air.
To
And
make us
so,
feel better. Yeah.
and I only use that as an example because we have loan applications on the consumer side. I can go to one of the fintechs in 2 minutes and get a loan and the money's in my account. And I just work with a credit union, maybe 35 or 15, 35 or $40 million in assets. Old time credit union, good little credit union. So I said, how long if I commit to an auto loan, how long does it take me to get it? It'll take 2 days. 2 days. I said, so how many auto loans do you actually close? Well, we don't close a lot of the applications we get because members done elsewhere got the loan. Why do you think that is? Because I'm a question guy kind of. Why do you Well, because they got the loan faster at the dealership. So weren't able to help your member because it took 2 days to get the loan. They got the loan elsewhere. Do you think maybe your process needs to be revised? Well, but this is the way we do it. So how's it working for you?
Mhm.
How's it working for you? I know what your loan volume is. I know what it wasn't. It isn't. And why are you losing those loans? We used to do an analysis. And I recommend this to all the credit unions. I said once a year, ask your credit bureau to run a loan, an analysis of your membership and find out how many dollars in loans they did elsewhere this last year.
Mhm.
And you'll be surprised that you may have had a great year and you did $10 million worth of loans and your members did $100 million worth of loans elsewhere. Where were you?
Mhm.
And when you start looking at things in that perspective, it starts changing your process because you have to figure out why. And I think that's the real issue. I think loan processes, I get it, but why do you underwrite a home equity loan the way you underwrite a first mortgage? I worked at Freddie Mac for 5 years, and I helped develop some of the guidelines. And I will tell you, they were never intended for a home equity loan. They were intended to make mortgage loans investment quality so that the securities that they went into would be ubiquitous in nature and the investment
Mhm.
community would like them. Those requirements are not necessarily what makes a loan good or bad. It makes a loan investment quality. it doesn't translate to a home equity loan, which is basically a consumer loan on steroids. If you're doing
Mhm.
loans of, under a certain amount of money, why wouldn't you do them the same way that you do an automobile loan? You give me $150,000 loan for a Mercedes, and give me, we'll just say in a day, but you take 3 months to do me $150,000 home equity loan.
Mhm.
So I don't think we ask ourselves those questions and we're all very um, proud of what we do, and we think we have the best system in the world. But sometimes you better ask your members how they feel about the system.
Right,
And that
right.
that exercise I said about having the credit bureau run against your membership is a great exercise. Well, I guess they
Mhm.
don't really like you as much as you think they do.
Right. Yeah. No, I'm sure that's very eye-opening at most, if not all, credit unions.
And when I was at the big credit union, those numbers used to be really scary because we would do a lot of loans, and yet you
Mhm.
look at what the members did, it was like, wow,
Yeah.
how can we capture some percentage of that? And we would have had, instead of net 7 or 8% net growth this year, we might have had a 15% net growth and still been fine, as far as
Mhm.
everything else. But again, that's the real problem. I think our processes are just too antiquated, and they're built in tradition and folklore, and they're not
Mm.
necessarily built from a risk management perspective.
Right, right. It's no longer, "I know Bob's cousin because he works at the," no.
That
Um,
didn't work for even the $15 million trade anymore. You have 4,000 members or whatever. You tell me
yeah,
that the loan officer knows all 4,000 members.
right.
That's
Yeah.
not possible. You know.
And so why don't you give us a star example of and what characteristics make this credit union a star example of like a C results client credit union?
Well, the trouble is a lot of the ones that are stars don't need us. But so the Star Credit Union, I use a credit union I left, which is, in my opinion, is a lending machine. And I don't mean that in a derogatory sense, but if you can go online at 3 in the morning and get a signature loan and have the money in your checking account at 3 in the morning because you need to fly to Aunt Tilly's funeral, that's a Star Credit Union.
Mhm.
And there are credit unions today that are doing that, just that.
Mhm.
And so, how do you get to that point? You know, you've got to get you got to put first of all, I blame a lot of this on CLOs that are not innovative, um, or they don't have the ability to be innovative because the leadership above them is not willing to change the process. You know, it's the
Mhm.
the old mortgage file thing. If the file is not thick, then it's going to be picked out by the regulators. Yeah, I don't know if I ever told you the story, but when I first started out, Viola Billings was the chairman of the board of the agricultural and industrial cooperative I first worked for. And she went into the board, she said, I'm going to teach you some things today. Okay. She was a very large, tall lady with a big bun on her head. I still remember. But she was very smart. And she was the chairman of the board of this institution. She walked into the vault and she said, that's a good loan file and that's a bad loan file. I said, they're both green. She said, the good one is really fat. The bad one is really thin. I said, okay, why? She said, because when the examiners come in, this is back to, they pick out all the thin files and go through that. And, being 20-year-old, that's kind of like, yeah, okay, whatever. Viola, Mrs. Billings, whatever you say, Mrs. Billings. But she said, and you know what? When the examiners come in 3 months, you're in charge of working with the examiners.
Oh,
So I went into the vault with the examiners. Lo and behold, they picked out every thin loan file. So what did the new when I got promoted and was in charge of lending, I told them stuff the damn files, get dog licenses,
exactly.
whatever you can get to make that file as thick as possible. They never got pulled because only the thin files got pulled. That's a true story. And unfortunately, that folklore travels through. And so what happens generation to generation, the big file is really necessary. Getting references, which was maybe necessary in 1970, but in 2024, not so much so. So our processes look that way too, though. If you put a
Mhm.
lot of documentation, the loan is better. No, it isn't. The loan is only as good as the characteristics of its risk model, not the characteristics of the loan file. If you put a dog license there, it doesn't make that loan file any better than it was before. And
In
I'm being
fact,
a
you're
little
costing
sarcastic.
paper.
You're just getting paper. And to
Yep.
me, a loan filer doesn't at BCU. I can remember I told Pat Smith, who was the boss at the time, I said, "What's your vision?" I said, "My vision is to have to get to the point where there is only one person in lending doing 10 times the amount of loans we do today." She said, "Well, it's not possible." I said, "That's a figurative discussion about getting to the point where we need less and less and less so that we could get to the point where technically you'd have one person being able to carry many, many loans."
Mhm.
And so that's what the process was. We kept on reinventing and reimagining the process, rechecking to make sure the risk model was still in place. Our losses were what we expected them to be. They were manageable, but evolving it to get to the point where we got more and more efficient. So the member experience was great. And best story. Member who worked at the Boeing company had bought an automobile loan 10 years prior to this particular time that I was there. And he was a friend of mine. He said he said he relayed the story a couple of days later. He says, "Well, I took the entire day off from work because I knew it's the last time I went for a loan at the credit union. It was going to take a whole day to get the loan check to go to the dealership." He says, "I got there at 9 o'clock, and at 9:12, I was walking out with my loan check, and I had the rest of the day free to go drive in my new car." That story, and I've told that many times because that story is what happens when you reimagine your loan process.
Mhm. Yeah,
And so what happened
absolutely.
with the member? He was wowed, right? His expectation was 8 hours of sitting in a chair reading a book. There was no Kindles and there were no iPhones in that particular generation. But instead, he was able to go drive in his car on a sunny day in Seattle, which is unusual to begin with.
Unusual.
So to me, that's the real problem: is not really being willing to look at what you do and stripping it back and
Yeah.
really starting to make it easier. And it's been interesting. I've tightened up a lot of lending processes for credit unions that we worked on. At the same time, made it easier for them to make loans. And it's kind of at first they didn't understand it. And I said, "You're managing the risk model, but the experience is a lot better. You're doing it behind the scenes. The member doesn't need to see your gerbils in action. They need to feel, that it's a great experience."
Mhm. And that means getting them in and out as quickly as possible usually.
And and wowing them. You want to always
Yeah.
wow them. And you want to also make sure that what they thought, what you say, and what they feel are aligned.
Yes.
Because when they are, that's a good relationship. They leave thinking, "Wow, that's my credit union," and they go out and they tell, their friends and family about that credit union.
Yeah. And that's how you
And
decommoditize it.
yeah, that's how you decommoditize it. Commoditize it,
Decommoditize.
yes. And I think the interesting thing is, if you look at some of the larger credit unions, some of them operate still as little credit unions. They're big, but they
Mhm.
still they still operate as little credit unions. As far as that personal touch, that having having a personality. I think the other thing about lending, until a credit union can tell me who they are, they'll never be a successful lender. Who are you?
Mhm.
Who are you? If you tell me in 2 sentences who you are as a credit union.
Mhm.
If you can't tell me that, I can't tell you why I want to loan with you because you can't translate it to your products and services.
Mhm.
So when these credit unions, embrace, we'll say, financial empowerment, I now understand that their mindset is to help members have all the tools necessary to live a healthy financial life.
Mhm.
Now I understand how the loans fit into that, right? So they're dreams, right? So I need a car to get to work, school, or worship. That's actually another thing. Strategy at the product level. Are you lending doing automobile lending to get automobile loans, or are you lending to get members into vehicles to get safely to work, school, and worship?
Mhm.
Those are two different things, and they do change how you actually look at the loans. And
Mhm.
once you become a credit union and do the work, school, and worship rather than just the car loan, indirect loans become less and less appropriate because they don't fit into that other mold.
Right.
Now, it may be that you just want car loans for car loans, in which case that's what you get. So to me, it's really understanding why you lend. And when you understand that, then you can figure out how to make the products work. And then just get rid of all the things that don't feel right. I always ask, tell me the value of that step. Tell me how it improves the safety and soundness of this loan. Tell me how, and if you can't do that, get rid of the step.
Yeah.
Just get rid of it.
Yeah, no, perfect. Makes perfect sense. So, Joe, as you know, I offer my guests final thoughts. We've talked about a lot today regarding lending. What are you going to leave our credit union audience with? What's your final thought?
I still believe in the credit union model, and I think that we have the ability to regain our position as the premier consumer lending vehicle in the marketplace. But we've got to go back to who we used to be in some respects. Everything old is new again. And to me, being relevant, understanding how to listen to a member, understanding how to structure a relationship that benefits the member first versus the credit union first will
Hmm.
always be successful. And I think that's the key. And I have a successful track record, as most of the folks listening to this probably know. And it's all about, you know, trusting the value of a cooperative in a way that provides a unique member experience and value to those members so they understand the difference. Because we can shout the differences and we can talk about our eyes wide open and all those other things, but it isn't what you're called, it's who you are. And I'm
Hmm.
going to relate it to a story that have a debate that occurred in credit union times in the year probably 2012 around a name change. And there were some folks that were really upset that a credit union dropped the federal credit union and called themselves financial. And that credit union today is $3.5 billion and has 250,000 members and quite successful because we knew who we were. And the members understood who we were because our actions were aligned with what they thought, what we said, and what they felt. And to me, that's all credit unions have to do. If they could do that, they'll be successful. It isn't what you call yourself, it's who you are.
Yep.
So
Awesome.
those are
Well,
my
thank you
fun
so much.
words.
Yes, those were fun. Yes, I do remember those days. Well, thank you so much, Joe. I appreciate your time and your expertise today, and look forward to seeing you soon.
Yeah. Good to see you, sir. Have a great
You
day.
too.
Bye bye.